What's up, guys? It's Rowan
and Terry
from ArtofSmartTV, and we're bringing you another episode of the HSC Economics review. Now, in this episode, we're going to be diving into Australia's exchange rate. It's been doing some interesting things this year, and the exchange rate has huge implications on the rest of the economy. And so we thought, given that the exchange rate has such an important role, it's a really critical topic to nail for HSC Economics. So I guess to kick us off, Terry, an initial question: what's been going on with the Australian dollar? What's the trends like right now?
Okay, so the Australian dollar this year hasn't been good, right? It's had a lot of volatility, and it's also fallen a lot in that same period, right? We're looking at the lowest exchange rate since the GFC in 2009. So that was due to a one-off event, right? That was a one-off total loss of confidence. But what would be driving us now to these levels? So we're going to look at today just breaking it down into some global factors, some domestic factors. But to give you an indication, right now, our exchange rate is currently sitting at 68 US cents.
So it's broken that 70 cent mark. For so long, our currency fluctuated between really 70 and 80. Yeah. Sure, it has highs, during the mining boom, but realistically, most of the time, 70 to 80, you can basically bet your money that's what it's going to be. But more recently, and literally you're doing that if you're trading on the Forex, but that's another story.
I was like, I saw
that pun. But seriously here, okay, it's cracked a low. Now, I suppose, what's causing it, right? Like, it's not one-off factors, like the GFC. Yeah. Something else is going on here. Yeah. What's happening?
Well, I think recognizing that it isn't a one-off factor, I think the most important thing is recognizing we are in a new ball game. That's what I feel like with the global economy. Things have changed. Things are different now. And so having a look at what's been happening over the past 2 years or so, there hasn't been a very strong global growth, right? There hasn't been a very good outlook. There's been disruptions in the US, in China, in Europe. We've got this thing called the US-China trade war. So many things are doing their best efforts just to dampen the demand for Australian exports. Now, the reason why I bring that up is because the basis of an exchange rate is it's floating. It's determined by forces of supply and demand, right? And when we have an appreciation, it's when we have a strong demand for our dollar. And when there's depreciation, it's weak demand. So when there's a weak demand for our exports, that pretty much means we're going to have a weak demand for our dollars, because that's what people use to pay for our export.
So I think the really interesting thing, just to build on what Terry has said, is that certainly, we've seen, and I think the US-China trade war is what gets, a lot of the focus right now, because obviously, it's in the news every day and it's very present, and given our relationship with China, it's also very important in its outcome for us. But I think when we look at it globally, what we certainly see is also, a really sort of flatlining EU. The EU is, your other major sort of economic bloc, is also not performing very well. Okay, so there's been really weak manufacturing growth throughout the EU. And so we've got this really general sense of, okay, the global economy is pretty weak. And ultimately, during periods of that weakness, you're going to get lower confidence. Mm-hmm. And, the Australian currency is the fifth most traded currency in the world, right? So, 95% of trade is actually speculation. It's so it's interesting, like the counterpoint that I'm going to make to Terry's point is that Terry's point is, yes, global demand is all down. Maybe people are therefore buying less exports from Australia. But the counterpoint is, well, most of the trade in the dollar is actually speculation anyway, right? It's not necessarily driven by trade. And for us, the issue is that because it's the confidence is so low, it's dampening people's appetite to even speculate on the Australian currency in terms of where it's going and also where our economy is going. So it's interesting because, Josh Frydenberg, the treasurer, right? His opinion is very much that most of what's going on, yes, there's multiple factors at play, but ultimately, it's just par of the course, right? It's par of the course for being such a traded currency that we're going to see this sort of fluctuation. I think what's interesting though is that that's sort of zooming out. Let's bring it back to the US. Mm-hmm. Let's bring it back to China for a moment, Terry. How do the interest rates play into this as well?
Well, so the other thing is, as long as with exports, right, you've also got this idea of foreign investment. So you not only have to pay for exports, you also need to finance your investment, and that requires usually purchasing currency of the economy you're planning to invest in, right? And so with the US, right, they've actually increased their interest rates quite a bit, right? So they were sitting at, that 0.25 to 0.5% Fed rate for such a long time. Then they successively increased it, I think it was to 2.5%, right? And so what we're actually seeing now is that since pretty much, I think it was April last year or March 2018, the US Fed rate has actually been higher than the Australian cash rate. And then you've also had to couple that with the fact that we've dropped our cash rate 2 times in June and July of this year. This interest rate differential is just continuing to grow. Okay, and when we do have that interest rate differential, that means people are going to prefer to invest in the US, right? Because it's just a larger economy in general, right? But also if they're getting a better return there, then they're obviously going to be funneling their funds over there rather than Australia. Okay.
So we've got an interest rate differential. So if we quickly zoom out for a moment, we've got factors like just weak growth, globally. We've got, the EU struggling. We've got, as a result, less demand for our exports. But we've also got an interest rate differential at play. And then we've also got, due to this lack of sort of certainty and confidence, sort of, different attitudes towards speculation in the Australian currency, which is all causing our currency to not perform particularly well. Now, I think there is some stuff going on domestically as well that potentially influences this. What's some of the stuff that's been happening domestically that also is influencing our, short of the interest rates, of course, influencing our currency valuations at the moment?
Well, I think one positive for us is that, well, it's not really positive actually. One positive for the exchange rate, I should say. With such weak consumption, right, with such weak confidence in Australia, we also consume a lower amount of imports. And that's actually been a little bit of a positive in helping with the exchange rate because we also don't spend as much on imports, which therefore means our dollar will kind of maintain a higher exchange rate, right? But for me, I'm really just focused on the fact that, because growth is so weak, right, the RBA is so focused, right, on just maintaining domestic aggregate demand that anything that happens with the exchange rate is more of just an afterthought at this stage.
And I think maybe the one thing that is happening domestically, and it's too early to say, is arguably the impacts of the successive rate cuts that we saw, to sort of take the interest rate or the cash rate to 1%, has seen, the RBA argue that we're sort of now seeing a soft recovery. And so the one thing that may see our dollar, potentially pick up a little bit in, the rest of the year, and analysts are predicting it'll return by the end of the year to 75 cents. So mid-range that we typically see it, is a return to slightly stronger economic conditions and confidence in the Australian economy. Now, of course, it's, I think, a little too early to really say, whether or not that's going to be the case, but certainly, that's something that's going on domestically that may influence the overall value across the rest of this year. So I think the big thing we've got to really consider here, and it's, to link it really explicitly to the HSC Economics course, one of the questions that you can often get as an essay question is, to analyse the impact of changes in the exchange rate on the economy. And so, we've clearly had a change in the exchange rate here. It's depreciated, to these 10-year lows. And so I think what we need to understand is what's the impact of this, right? What are the implications for the Australian economy? So what do you think, Terry?
All right, well, I'm going to frame this around just your balance of payments. Right, so to start us off, when you have a depreciation, just at least in the short run, you're going to be receiving less income for your exports. But more interesting, which I think is in the more of the medium to long term effect, right? When you have this kind of sustained depreciation, which I would say we are getting into that territory, right? We have had it sustained under 70% mark for a while, is that it actually tends to improve your international competitiveness a little, right? Because if you think about it, you might have learnt about the J curve, right? But just to very quickly go into the J curve, it's just this idea that after a depreciation, initially your trade balance is going to suffer a little bit, right? Because you're just simply not earning as much.
And you're also paying more for imports.
Okay, thank you.
Double whammy.
Yeah, double whammy. Right, but very quickly it will actually start to take something what's called a volume effect, in the sense that you're actually going to start to sell a little bit more exports because it's now relatively cheaper and more competitive. And so in the medium to long term, you actually start to benefit from this depreciation, right? And as Australia is so, I guess, reliant, right, on our commodities exports, this could potentially really help.
And I think what's interesting is that it does turn on, and I think the commodity exports is an interesting observation, because for the J-curve to play out, it also turns on the elasticity, right, of your exports. So it's assuming that falls in price do result in increases in demand to create that volume effect. I think Australia's been able to reap sort of two benefits here, right, from the depreciated currency. The first is, of course, improved international competitiveness, which is probably less important actually for our commodities and more important for our other exports. Mm-hmm. So if we think about our agricultural exports, we think about our service exports, including financial services and education, a lower dollar is actually incredible. It makes Australia really attractive, right? Yeah. So I think that's been really powerful. Now, we've been really fortunate because I think at the same time, there's been a global recovery in commodity prices more broadly. So not only have we seen, our dollar fall, which has meant that our international competitiveness in services, for example, have improved, we're also getting more money at the same time for our commodities, which is creating a really nice sort of outcome here for us. So what's been the impact then for, our BOGs, our balance of goods and services as a result of this?
It's been great. So the BOGs has responded fantastically, right? We've got this $8 billion surplus in the June quarter, right? And that was, I think it also had a pretty big surplus in the March quarter as well, right? It's just growing and growing, and we've actually going to get just a 2.9 billion current account deficit, one of the smallest since the 1970s, right? So,
and there's been talk of the miraculous maybe surplus, right? I wouldn't go that far, but
there is this idea of a maybe surplus as well, but that probably won't stay, right? I think it's definitely a once-off, right? But it's just nice to see, right, that, you guys have been learning so much about this, persistent current account deficit that, just maybe we might have had that one quarter where we did have that surplus. But it has been fantastic for the BOGs.
Which it's important to note, if we're thinking external stability fatigue, it's very much a cyclical benefit, which is why it's probably not going to be long-lived unless we continue to sit in this long-term, low currency environment.
And it just further goes on to the fact that, you do have these cyclical elements as well as your structural elements that kind of sustain your current account deficit. So things like, the savings investment gap, that is a much more structural issue, right, which isn't going away.
I think what's interesting for me, I think in all of this as well, is that, the lower dollar has another impact, right, which improves, and it's the other side of how our BOGs has improved, in that imports are more expensive. So not only are we generating, increased revenue through a volume effect for our exports, we're also actually seeing people spend less on imports.
And that's also due to the domestic factors within ourselves. Right?
Well, it's a double whammy, isn't it? We're lower economic growth, so we're spending less anyway, and then the currency's, lower in value, so things are more expensive, so we spend a little less. And so that certainly has some positive implications. Now, I think if we were to sort of zoom out a little bit more, there are some other implications, I suppose, of this currency being under 70 cents. And I think at a basic level, just to connect it to some of that external stability, we're going to see some valuation effect stuff happen here. Okay, and again, the degree to which that's being sort of hedged out, is a factor that you want to consider. But ultimately, if our dollar is depreciating in value, we're going to see the overall size of our net foreign debt that's denominated in foreign currency grow in value. It's going to see our servicing costs grow in value. And so when we do look at the overall CAD, and the overall outcome for our current account, we've got to really balance the fact that a lower currency, value typically improves our BOGs, but it can have the opposite effect, right, on your net primary income, depending on economic growth conditions in the country. So, the end outcome here is it's probably, both good and not as good, but overall, I think, given that we've hedged a lot of our servicing costs anyway, which means that, they're denominated in Australian currency, which means that if our currency falls, our sort of servicing costs fall, right? It means overall the impact on our current account as a whole tends to be positive, which is really, really good. So guys, just as I guess we wrap up here, I think hopefully what this has given you is a good sense of, the trends in the Australian, currency, what's going on, and then the fact that there are multiple factors that are causing this, and it's actually quite really sort of quite momentous. And I'm going to use that because remember the last time, as Terry highlighted at the start of this episode, the last time we saw this was a singular GFC event that caused our currency to be as low as it is. So I think it makes for really interesting times right now to be studying economics. So hopefully what this has finally given you is some critical analysis on how to think about the impacts of the current currency so you can nail that economics essay when you need to analyse the effects of changes in the exchange rate on the Australian economy. That's it for today. We'll see you
next time.
Next time.